Good evening, good morning, depending on where you are in the world. I'd like to introduce you to Chapter 6 of How to Write a Business Plan. Before I do it, I'd like to give full credit to the author for this book and let you know this is for review, educational, and informational purposes. The purpose is to convey the information already in the public domain about this book about how to write a business plan. It's not to take the credit for the intellectual property of the book. Full credit to the intellectual property goes to NOLA, which is the publisher, and to the author, Mike McKeever. That out of the way, let's go to Chapter 6 and talk about today's subject. Our topic for today, and the subject of how to write a business plan, is about your profit and loss forecast. Remember, a forecast involves predicting things based upon having past data. It is not just to make wild guesses, it is based upon having data, which gives you an educated guess, meaning you have information that's based upon statistical and historical information. Remember, we're talking about profit and loss. That means you made more than you spent. Loss is you spent more than you made. With that in mind, we're going to talk about what profit and loss forecast is. I'm going to give you an introduction about it, then we're going to talk more about what is a profit and loss forecast. We're going to determine your average cost of sales. We're going to complete your profit and loss forecast. We're going to review your profit and loss forecast and your profit and loss forecast and income tax return in this case. Now to give you an introduction about this. Before I do that, I'd like to let you know that if you've chosen a quick plan method to prepare a business plan, you'll need to read and complete the section, complete your profit and loss below. If you have any difficulties completing your profit and loss forecast, go back to Chapter 3 and read is a section entitled Break Even Analysis. Will your business make money? Before completing this step, if you've chosen a quick plan, you should be able to complete this step easily. Now, in terms of the introduction of this chapter, understand that your next job is to forecast how much money you'll need. Okay, you can't make realistic financial projections in a vacuum. They must be integrated into a thought-through plan. As a result, you'll need to make a number of decisions about how your business will operate and forecast the financial results. Okay? You need to be able to have some indication of, is it more likely it will succeed in terms of profit, or is it more likely it's going to fail in terms of taking losses? You've probably been thinking about the financial side of the business for some time, if this is a new business. And also, if you've seen the previous lectures and chapters I've gone over, you have already thought about that because I've talked about that in the videos. You will inevitably need to make some assumptions and even a guess or two. Of course, you should make your projections as accurate as possible. What you want to do is shoot for accuracy rate of plus or minus 10%. So that's what you want, accuracy rate of plus or minus 10%. Now, be careful about assumptions because you want to make sure you have the data required to make decisions. If it's a common sense logical assumption, those are the type of things that are basically the prerequisites before you're able to do. Remember that project development is that if you plan to do if you plan to execute a project development, you can skip the rest of the chapter and go to chapter 7, which is the next chapter. Then you can go to Appendix C, and of course, people like to give me notifications when I'm busy here. As you begin dealing with the details of inherent financial projections, it is easy to lose perspective and forget about the larger picture. That is, what all your work is supposed to prove. What is it supposed to prove? Well, obviously, the first thing it's supposed to prove is that you're supposed to run a business and make a profit. Okay? If this happens, pause for a moment and remember that for yourself and your potential backers, you're simply figuring out the following. Number one, how much money you will need. How much money you need. Number two, what you will spend it on. Meaning, what's the financial need for what you need to spend the money on, and how much will you pay it back? Excuse me. How will you pay it back? I'm thinking of both at the same time. Okay. Now, if we're talking about backers in terms of loans, that is how will we pay it back? As I said before, it's recommended that you go for venture capitalists and equity investors that invest in the business and get an equity share of the business. That way you don't have to pay back that part, but they'll have an investment they put into it. Okay, that increases the value of the business once there's investment. Then you give them, based upon the agreement, you give them a share of the business. Now, come to that percentage will be based upon the valuation of the business, which is way beyond the scope of this book. At some point, I will go over a course on valuation, but not at this point, as we haven't even talked about the ground level, even foundational. We've gone over all the foundational things. Valuation is pretty much going to be way at the top. There's the roof, but all of it's connected. So that'll be something we'll talk about later. But just the idea is when you give someone a stake or percentage equity stake in a business, that's based upon them getting a certain percentage of the profits that's coming from the business. Now, you might ask yourself, what is a profit and a loss forecast? Well, a profit and loss forecast is a projection on how you will sell and how much you will sell and how much profit you will make. This is the foundation of a business plan. It gives you and the potential backers the basic information necessary to decide whether your business will succeed. Basically, a profit and loss forecast forces you to estimate how many dollars you'll take and how many dollars you'll spend for some future period. Because that is part of your expenses, if you remember from before. Well, other extremely important factors affect your business, each as in your cash flow, as I mentioned before. You've got to have a cash flowing business, otherwise, it's no good. And we'll talk more about that tomorrow in chapter 7. As you know, in chapter 3, we completed a rough break-even analysis for your business. That analysis helped you decide whether you chose the right business. What we're going to focus on for this chapter is we're going to take a closer look at the numbers and to develop them into a comprehensive forecast of your business's future profits. If you did not complete or don't remember the work you did, then review this section on chapter 3, which is break-even analysis. Very important because you need to know how many sales, how much in terms of sales, and how many sales you need to make to break even, and then past that, how much do you need to figure out your profit margin. And anything above that, how many sales you're going to make. Now, it's going to depend on the revenue. You're going to have your profit margin times your sales is going to give you your revenue. That's past break even. So you have two things, don't forget, from chapter 3. First is the break even analysis, meaning how much money do you have to make in revenue to cover expenses just to break even so there's no loss. Then past that, we talked about past break even, which is how many sales you need to make more than just breaking even, to do more than just a break even. Now, your business profits result from three specific dollar figures. Number one, we have sales revenue. This is all the money you take into your business each month. Pretty basic, right? It's also called gross sales. Gross refers to before expenses. Now, you also have, so first of all, we need to consider sales revenue, how much are you making before expenses, such as your fixed expenses, your taxes, and any other variable expenses. And we also need, after that, after sales revenue, we need to look at the cost of sales. This is the direct cost of the product or service you sell. So basically what it is how much does it cost to produce that sale? So that could be how much do you pay for overhead, total overhead, or it could be just simply, depending on the definition, it could also be how much does it cost to make that sale in terms of what you pay the person who makes the sale itself. It's also, according to this book, also called direct product costs or variable costs. Now, it can be variable if one salesperson costs more than another because maybe the person okay, so let's say that month you paid more to that salesperson, but he produced a lot more. Meaning he had produced at a higher rate than the cheaper seller, the one that you paid less for the sales to produce sales. Now, we also, as I said before, we have the fixed expenses. These are expenses that don't change from month to month. These are sometimes called overhead, as I mentioned before. You must pay them regardless of how well you do. Fixed expenses don't vary much from month to month. They include rent, insurance, set expenses, all fixed costs or fixed expenses. Otherwise known as operating expenses or expenses. These are different terminologies. And then we also have something called discretionary costs. That's another story. Those are talked about in chapter 3 with will your business make money? Now, in a given period, you make profits when your revenue exceeds your total cost of sales and fixed expenses. Okay, so basically, what it is you take all of your expenses and all of your revenue, you compare the two. Which one is more? Okay, the revenue is more. Okay, then you made a profit. If your expenses are more than your revenue, then you had a loss and not a profit. If they're exactly the same, I mean exactly down to the last digit, that means you had to break even. So that's three things. It can happen in business. You either profit, you make more money than you spend. You have a loss, which means you spend more than you make. Or you have a break even, which means you make the same amount of money as you spent. Our purpose here is to examine closely all the above numbers, and once you convince they're right, to represent them on a month-by-month basis for 2 years. Now remember that the reason for remember we talked about 2 to 3 years, this is for purpose of backers. One could be for loans and two could be for venture capitalists or equity investors, otherwise known as equity investors. There's different types of equity you can offer, but that's what it is. Okay, now you can change the time frame if necessary. 2 years is enough time so you can see if there's any short-term problems or long-range trends begin. Remember, I told you they need to see a trend. How did you do first year? Second year, are you doing the same? Are you doing worse, or are you doing better? And how much? Worse, better, and what is the trend? If we have 3 years, we can see an even better trend because we can see first, second, and then third. So first, you can have one bad year, but if we have a consecutive of bad years, and that is a bad sign, of course. What we want to be doing is we want to be going up. Maybe first year is flat. Next year it's a little more, and after, and then compare. It's always compared to the previous year. The next one is the next one, and so from year to year, we want to be increasing our revenue compared to our expenses. And then also we want to look at an overall trend on the line graph to see what the trend is. So we have Y is revenue and X is time. So revenue over time. Then we can also look at, and then the second line graph, that's Y, so we have revenue slash expenses. So 1, you can color code it or put 1. So number 1 is revenue, and number 2 is expenses. You should have an inverse relationship, meaning there should be more revenue than expenses. As time increases, the revenue should increase more than the revenue, more than the expenses. The more efficient you are, the more the trend goes to the opposite, meaning the more you have in hyperbolics, you have an inverse relationship where as efficiency increases, you have more expenses while at the same time, you have more revenue while you have less expenses. That is with increased efficiency, which is another topic altogether. Now, here's what we want to do. We want to determine your average cost of sales. First step in your profit and loss projection is to determine your average cost of sales. That is the direct cost of products and services you sell. What is the cost of sourcing it? What is the cost of using it? That could be anything. That's everything from acquiring the items that you need, and also any other services used with the item that you have. Just like in a restaurant, what do you have? You have equipment to cook the food, and then you have the food itself. Now, one way to derive the average cost of sales is to estimate your annual sales revenue for each product or service. Now, here's what it is. This is the average cost of sales. So what you do is you take all the costs, and if we're talking about annually or yearly, we add up all the 12 years, the cost of all the 12 months, not the 12 months, but the 12 months, right? And then divided by 12 months. That will give us our monthly average. If we have more than 1 year, we add up the total cost per year, right, and add up all the years, of all the costs for all the years, and divide it by how many years. So if it's 2, 3, whatever it is, 1, 2, or 3, you divide it by how many years. Then you calculate each product's annual cost of sales. So what does it cost to produce the sale? So you have your revenue of the product or service, and then you subtract the cost of getting the sale. Then we have a gross profit. Why is it gross? Because unless it includes all overhead expenses, that would just be part of it. It's only one consideration. Now, another way to calculate your average cost of sales is to make separate monthly sales revenue and cost forecasts for each of your major product lines or service lines. You complete a separate monthly forecast for each of your product service lines. You'll have a detailed forecast, just like this. Suppose I have 2 or more products or services that I'm offering. Okay, so let's say products. Okay, I'm selling, for example, cars and computers. Okay, this car I sell for X amount of dollars. This computer, also, all the cars I sold it for X amount of dollars. All the computers I sold for X amount of dollars. Okay? So you have your revenue for each one separately. Calculated separately, we calculate the revenue from the cars, for example, and then you subtract what it costs per sale, and you divide by how many sales. It'll give you your average cost per sales. Okay? The idea is averages because it depends on each month or each one, depends on what it is. Especially if you have different variations, different what they call lines. Same thing with the computer. You have you could actually sell two to three kinds. If you want to talk about lines now, we're talking about two or three kinds. So we have, let's say, high end and low end. Okay? It's simple, something simple, right? High end and low end. Okay, we add up the revenue from the high end and we add up the revenue from the low end. Those are two separate entries. And we consider the cost of the sale for to sell the high end and the cost of the sale for the low end. So we subtract the high end sales minus the cost of the sale. What we do is we add that up, total for whatever duration of time, month, year, divided by whatever the duration is. So the duration could be 12 months or how many days per month. Depends on what we want to measure. Remember that we need to keep these separately because these are two different things. Two different products, also services. Same thing. You have the revenue from the service, how much it costs to get the sale from the revenue. Remember, we're averaging, we're trying to figure out the cost per sale. That's what it is. You can see here it says finally add up the numbers to get an idea. So you add up all the cost of this, let's say cars, right? Subtract the cost of the making the sale, divided by how many, whatever it is, months, days, years, whatever it is. Same thing with the computers. All the sales, subtract for each one, subtract the cost from each one, get subtotals, add them all up, divided by whatever it is. Same thing with cars now. You get your subtotals for each brand, car, whatever it is, you do the same thing. Revenue minus how much it cost. Each sale. Add up the differences between add up the difference between the two. So let's say it's you made $10,000. The cost was I don't know $2,000, whatever $3,000. That's $7,000. Add up all those like that. You get a subtotal. And you do the same thing with computers. You add all of them up. You itemize, add. So you have each one subtract for each transaction. Right? Then you take the differences for each one, add all of them up. That's one subtotal. And then the same thing with computers. Each one, take the differences, add all of them up, and you have that. Now, for each subtotal, you can divide it by whatever the duration is. So if it's 30 days, you divide it by 30 days if you want the daily. If you want the monthly, you divide it by so divided by 30 days is how much per month? So let's say you want multiple months, right? Let's say 12 months out of the year, right? Divided by 12. If it's multiple years, we divide it by how many years, and we say per year, per month, or even per day, depending on what the situation is. Once you have whatever you're measuring to, you take that final subtotal and that final subtotal, add these two together and divide it by whatever we're dividing. That will give you your average. Now remember, what we're trying to do is determine the average cost of sales. So that's why we're dividing by, let's say, 30, if it's per month, or if it's per year, dividing by 12. If it's multiple years, we're dividing by 2 or more years, depending on exactly what it is. This is very straightforward. You just have to think about what are you measuring. So remember that when you calculate your average cost of sales, to make a separate monthly sales revenue and cost of sales forecast for each of your major product or service lines. That's why I said you have to itemize each category. cars, computers, services, education, financial, whatever it is. You're going to do those separately, get that separate subtotal. You do the difference between revenue and expenses, right? Revenue of the sale and cost per sale. You have each subtotal, add up all the subtotals, and a total, a category. Same thing with each one, we do it separately. And we add up all the totals, and we get a grand total at the end. One way you can do it so you know you don't get confused on what the grand total is, you put two lines that indicate a grand total versus a total itself will have one line. The difference, that's total and grand total. Total was one line, grand total was two lines. Okay, now caution, whether you make one annual cost of sales forecast or a number of detailed forecasts, don't forget about the inevitable percentage of merchandise you'll have to move as marked down prices. So that will decrease your profit because you're taking a loss on that. It's called oftentimes you get customers in the marketing terms it's called a loss leader. And that's the extra cost. So when you mark down the price, that's going to increase the cost per sale. Do you understand? You take the total cost per sale. There's different ways of measuring this. So you could say per hour. Let's say, depending. Actually, if you want to get real technical, what you would do is you say, okay, for each person that did that sale or responsible for the sale, you take the duration of time, right? Duration of time, the cost per hour that it costs. Let's say it took 1 hour, it's cost per hour, the salary, or it's a percentage of that. You add this, right? Their salary plus whatever the cost was for the sale itself. That includes everything else underneath. Add that up, and that's for the sale. So if it's sale, it's their salary divided by whatever it is. It's how many minutes over an hour or multiple hours. And then whatever you have that, and then you have that expense as well. So every other expense added to that, especially the cost of the item plus the cost of the salary. Now, there's other things like procurement costs, transportation. These are different categories. So this is gross profit, not net profit. Net profit is really involved because you have to look at itemize every single expense that's involved in that operation for that business. Then you can come up with a net profit. But gross profit is what you're talking about. For that. That's the gross profit when you take consider revenue minus the cost of the sale. That's kind of a little involved accounting wise, but that's basically what it is. The reason why they want to do is they want to see how much is it costing for each sale. That could answer questions on efficiency. That could lead to cost efficiency in terms of time it takes, in terms of which sale is most profitable, who are profitable customers. There's many things that answers. There's the marketing aspects, there's the operational aspects, there's the sales aspect, there's even the overhead aspect depending on what you need to do. So there's all those things you need to consider. Now, we have an example here of an average annual cost of sales. First, what we do is we have this forecast. This is you have each item is itemized, meaning you have a list on the name of the item, you list it, and you have the forecast sales revenue. So say, okay, for each sale you make this is the sales revenue of this sale, right? So of each item. So let's say it's $200,000. The cost per sale is, let's say, a little bit more than 50%. And then what do you have left over? That's the total cost of the sales. Forecast times the percentage, or you could minus the profit margin, but actually you would need to know the cost per sale before you know the profit margin. So you take the revenue of the sale and then you multiply by the cost per sale in terms of a percentage. If you know the percentage, or if you know the amount, you either know the percentage on the sale or the amount. And then if it's the amount, like a flat amount, that amount, you subtract the revenue from the amount, which is the expense, and you get the total cost of sale. It's the difference. If you know that the percentage of the cost as a percentage of the percentage cost per sale, right? This is a percentage of the sales revenue. So the percentage of the sales revenue will give you the total cost of sales. In other words, if you think of this logically, how much of a cost it, or literally what did it cost to make the sale? Going back to the same conclusion again. So we have different itemized things. Same thing. What was the cost of it? We get that amount. We add these up for each itemized. And we add up. So we add up all of our revenues for all the ones we sold. And we itemize for each one. We multiply by the cost of the percentage of the cost, the percentage of the sale, of the sale of the cost of the sale compared to the revenue. Let's say it costs 50% of the revenue. And that was the total cost of sale. You do it separately. Then after you have the total amount for the cost, you add those up. And then when you have all the revenues from all those, you add those up. And what you do is you subtract the revenue from the expense, or the expense in this case is the total cost of sales. Now, then once you have that, you take the difference. That is for each one. If you want to take the average now, what we do is we add up, we average, we take the average of these two and the average of these two, and then subtract. Or what we can do is this: we can add up, we can take the average of the two revenues and the average of the two cost sales. That will give us our revenue. So in this case, it says total average of cost of sales. Notice they said total, not itemized. Total average cost of sales is 61%. What is it? The total, that is 61.8%. What is that? It's the average. It's all the percentages of all the sales. It's itemized. You divide it by how many? So for example, 50.4 plus 73.3. Add the two up and divide it by 2. We have 61.8. That's what it is. The 61.8 is an average of the total amount of the total sales revenue. Wait, the total is what? The total is 400,000. Yeah. So it's basically the cost divided by the revenue equals the total amount of sales. So we could do it that way. We could look at the total and divided by the average. It gives us our percentage average, or we can get the flat amount. So the other way is, there's the other way to calculate is you take the two numbers, the total cost of sales for the two, divided by 2, two are the revenues divided by 2, and then subtract the 2, and what do you get? That's what it is. That's what it is. Now, here's how, so we also have, we also have average cost of sales for this example too. Remember, this is a pattern. We itemize all of our expenses first, we list it off. Then we take the revenue from each one of them. Then we take the cost per sale of each one. Then we get total cost of sales. That's what we're doing. We need to, you take the total amount of revenue and you multiply it by the cost per sale, right? So in terms of a percentage, so we have a flat amount, 300,000. Cost per sale, 38% of that to make the sale. And you get the total cost per sale for each one. You add all of them up, and then you divide it by how many. For total cost. Now, for total average, that's different story. Total average cost per sale. We have total average cost, which is the we have the average cost per sale in terms of cost per sale, average cost per sale in terms of a percentage. What we do is, I don't like how they phrase this, but basically that's what it is. What you do is you can take all of these numbers and divide it by 30. 38 plus 29 plus 75, and then add all of them up, divided by 3, because there's 3 itemized sales. The other way that they mention is total average cost of sales, which is 40%. What is it? You take the total amount, then you take the cost of the sales, and you divide it by the revenue. Notice we don't multiply it because we're doing an average. Whenever you do an average, you're always dividing. It's very simple, basic math. Now, by definition, service businesses sell services and labor that do not sell merchandise, as you know. Occasionally, you may bill a client for a service and they purchase outside of the firm, or bill for a service that has come into incidental costs. That means in the process of the cost of sales portion of a service business total cost will be low. For example, consulting firm may incur outsized typing, photocopying, or recording expenses that will vary somewhat from every sale. Most expenses such as salaries, rent, will be fixed costs. So remember, we have fixed and we have variable costs. They won't appear in this chart. So what we have here in this chart is we have annual average cost of sales. This is annual, so this is divided by 12. Sorry. This is every year, not monthly. Sorry, that's monthly, average monthly. We have every year. So what we do is you have to add up all the years and divide it by how many years. First, we start off again. We want to itemize by listing off all of the items by their name. Then we take a forecast sales revenue, whatever it is. That means how much money did we make from each one. Add them up. So we have a total, 677,000. Then for each one, we do is we look the cost per sale. Okay, for 100,000, it costs us 20%. What was the total cost of sale? 20,000. Okay, fine. And then for the next one, okay, it cost me 75% of the sales revenue to get the sale. So that's the total cost of sale, 37,500. And then for studies and consultation, there was no cost per sale. Okay. Let's suppose you didn't have to pay anybody to do the cost, whatever it was. And then you put 0% and it's 0. You add all those up. And then what you're doing is you're taking your total amount, 57,500, dividing by your revenue. So you take the total cost of sales, you divide it by the sales revenue, and what do you get? You get 8.5%. That's the average cost of sales. That means of all the sales, on average, they costed 8.5%. Why is it 8.5%? Because you're dividing one total into another total. That's why it's average. It sounds pretty obvious. Sounds like very basic math. We need to understand not just, we're not talking about the math so much as we're talking about the logic and the numbers, how they work. Now here I would recommend you complete your, as some homework, complete your profit and loss forecast. Now, as a cautionary note, there's a chance to revise the sales revenue numbers in case you think they need work. However, be sure you believe that will generate all the revenues you forecast. Make sure you don't do it backwards by writing down enough sales revenue to show the profits you want. Otherwise, you'll need to explain the backwards each month why things are as good as they say they would be. Remember, we need to do it in a certain order. Logically, we do the items, forecast for the sales revenue for all items, and the cost for each sale, because the cost is based upon the sale. Then we come up with the total cost of sales. We cannot know the total cost of sales if we don't have the cost per sale times the sales revenue. We need to do things in order so it's logical. So as you know, cost of sales, you enter your monthly dollar cost in sales, as I told you. Get these figure, multiply your monthly sales revenue forecast by average cost of sales percentage. Okay, cost of sales. Multiply sales revenue by the average cost of sales. Okay, so if you look at it, cost per sale. Okay. After we've added all those up, after we've figured out what the total cost per sale is, we divided the 57 into the total revenue. We added up all the total cost of the sales and all the sales revenue. Divide those two together, we have that percentage. That's the average cost of sales percentage. Average cost. Sorry, excuse me. Sales percentage is going to be on a per sale basis. Now, as a cautionary tell you, we made separate forecasts for sales revenue, cost of sales, and gross profit for each product line. Then what you do is you add them all together, the gross profit numbers, and enter them in a summary on line 3. That's gross profit. Let's subtract the cost of sales. So go back to here, cost per sale. Okay. As you remember, that's sales revenue times the cost per sale in terms of a percentage. Give your total cost per sale. So you have that each one itemized. You have that one. That is your gross profit. Oh, sorry, you subtract, you subtract basically, you subtract your total cost per sales revenue minus your total cost per sales, and you get your gross profit. Okay, so that's total. If gross profit is larger than fixed expenses for that month, you'll have a profit. Well, of course. Remember, if expenses, if revenue is more than expenses, you have a profit. And of course, if the opposite is true, then you have a loss. It's that simple. Remember, we need to include all expenses. We have fixed expenses. Remember, we talked about that before. That's the categories listed on the form that are the most common fixed expenses. These are things that don't hardly change at all from month to month. All fixed expense items reduce your profit so that you pay less business income tax. Now, so we look at our fixed expenses. Wages and salaries can change depending on how much is done. So for most small businesses, keep some employees on a fixed weekly or monthly work schedule regardless of how the business fluctuates. That way the reason why you want to do that is because we're talking about a forecast, meaning you should be able to know in advance what it's going to be. Why? Because we already have the information from before. Okay, so if we look at this financial statement, this is from year 1. This is profit and loss forecast. Year 1. First, we looked at each month. So in this case, they have listed 5, but let's say technically we'd have 12 of them. We add up all of the months involved in this forecast, right? March, April, May, June, July, and so on. And we take the cost of sale for each month. We add up the total cost. Remember, this is total. This is the cost of sale for the percentage. So if we know the percentage, you do 30,000 that month times the percentage equals the total cost of expenses, right? Because and then if you want to double check to make sure the percentage is right, you take 30,000 times 0.6 is 18,000. Is 18,000 60% of 30,000? If the answer is yes, then that's correct. Same thing here. Right? So remember, so that's the same thing. Okay, so we took whatever our amount is, we multiplied by the cost of sales. So let's say there's a fixed expense. Cost of sales, for example, is for each sale, the product, sorry, of that product as a fixed expense for each sale. Let's say it's 60%. You take your total revenue that month by the cost of sales as a percentage, and you get your total cost of sales. We need those two numbers because we need to find out what our profit is. You notice here, 30 minus 18 is 12. 33,800 minus 20,300 is 13,500. Very simple math. Same thing. These two numbers, you get your sales revenue minus total cost of sales, right? And what do you have at the end? You have your gross profit. And just from this forecast, that's why it's called gross profit. Gross profit is 100% minus the cost of the sale. It gives you gross profit. If you have a profit. If you don't have a profit, that will be a negative percentage because you lost money. And when you check it, what you do is you do the simple math. 30 minus 18, 12, that's correct. 33,800 minus 20,300, 13,500, that's correct. Do the math. 45,000 minus 27,000, 18,000, that's correct. Go to the next one. 37,500 minus 22,500, we have 15,000. That's correct. And so we want to make sure that the gross profit here, which is the bottom line for our backers, and only just the percentage, but the total amount is the bottom line. Then we double check our figures. Our gross profit is our goal, what we're trying to calculate. Make sure that these two numbers subtracted together equals the third number. First number minus second number equals third number. Now when we look at fixed expenses, let's look at fixed expenses. We need to add up all of our expenses month to month. Okay? So we do all wages and salaries. Every single month in that year. Payroll tax, rent, lease, marketing, advertising, insurance, accounting books, interest expense, depreciation, utilities, telephone supplies, bad debts, freight, miscellaneous, total fixed expenses. You add all those. Sorry, then we have a profit or a loss. Sorry, that's all of our expenses here. We have a profit or do we have a loss? If it's in parentheses, it's a loss. If it's not in parentheses, it's a profit. Why? If it's a loss, it means your expenses were more than your revenue. Remember, what we're calculating is the expenses. So we look at the total fixed expenses. When we add up all these, we get this amount. See that? What we do here is we take this. Right? We take this number, and we take, 12,000? We take our profit minus our, so this is just revenue and cost of sales. That's the reason why it's gross is because it doesn't include everything. Gross is before all of expenses. That is after all of expenses. What we're trying to do at the end is get a net amount. So first we start off with the gross profit. It's like, okay, if this is bad, then it's not going to matter about anything else. So we need to know that. I mean, because technically the rest of this stuff could not apply depending on what kind of business we're running. But what we do is once we have the gross profit, we subtract from the total fixed expenses. Now we'll tell you, do we have a profit or we have a loss? If we have a profit, it's gonna be a number without it being in parentheses. If it's a loss, it'll be in parentheses. Or you could put a minus next to it. Same thing. You take your gross, so March, you took 12,000, you minus 12,050, loss of 50. April, gross profit was 13,500. We subtracted 12,050. We have a difference of 1,450. That's profit. Same thing in May. Gross profit 18,000. Subtract total expenses as 12,050. What do we have for a difference? Oh, difference is $5,950. Just do the simple math. Gross profit minus total fixed expenses equals profit or loss. In June, 15,000 minus 12,050 equals 2,950. Then from this example, our fifth example is June. 13,500 subtracted 12,050, and what do we have? 1,450. That's a profit. Now what we do is, now technically we should have done for the whole month, for the whole year, we do all 12 months. But in this case, where we're doing 5 months, what we do is we add up all of these. Excuse me. After we have a profit and loss for each month, what we do is we add them all up together. We have minus 50 plus 1450 plus 5950 plus 2950 plus 1450. What's the answer? We just add all these up and give us our total profit. Now, same thing. We have August, September, October, November, December, January, February, whatever. We do all the months. Now, I would start with from January to December. That would be a simpler example, but you see, it's just 12 months in general, depending on when we started. So we could have started technically not in January, but for example in March. So it just depends. We just need 12 months of itemized activity here. So we show all these, 12 months of totals, and we show these. Remember, for each month we're looking at the sales revenue, the less of costs and sales in terms of percentage. What was the cost of the sale in terms of a percentage? Then what was our gross profits? Notice these totals are here. The important thing is we need to take those three, not the third category of numbers, and subtract it from. Let's subtract it from the total fixed expenses. What are we getting? Profit or loss. Okay, the same thing again. Is it in parentheses? That means it's a loss. If it's not in parentheses, that means it's a profit. Or you could express it as a minus. In the context, you know that means a loss. It depends on how you express it. Make sure it's put in the context. So what we do is we add up all these. We add up all the totals from the profit or loss. March of all 12 months. And we get the total profit or loss. That's the year total. You add up all of those. You see? If you want to know the average profit or loss, what you do is you take the total and you calculate the total number. Because we got to add up all the subtotals. All the totals for all those. We get a grand total, which is the year total. And then we divide the year total by 12 months. Or how many months, depending on what we're trying to calculate. So if it's yearly average, we divide it by how many months in that year, which is 12. So we take the year total and divide it by 12, and that will give us our monthly average. Your total will be adding up all the profit or loss of all the 12 months. Pretty easy, right? Okay, now, keep in mind that certain wages aren't fixed expenses. Some manufacturing businesses pay workers a piece rate basis or hire employees when orders are high and lay them off when businesses are slow. Okay, That means, as I said before, some months you have more labor costs and some months you have less, either because there's less demand, there's less need to produce more, or there's more demand to produce more. So labor is not always a fixed expense. It also depends on how you pay. Now there are some industries like manufacturing, and then there's other things like, for example, you save on some of these costs because you're not paying, for example, some of the tax paid. For example, let's say you hire independent contractors which do work for you, right? There's certain expenses you don't pay because that independent contractor pays that. That's just the payroll tax. You don't pay that because you're not a W-2, but you're a 1099. In terms of what I'm talking about, this is in context of the United States, and I don't know about other countries. Now, here we go. Others don't pay a salary at all, but compensate workers with commission. So some work on a commission. It's called commission sales. So you have to determine how do you pay the person. Do you pay them on salary, or do you pay them on commission, or do you pay them in a combination of ways? What you want to do is you want to make that clear up front. How do you pay? Is it salary or is it commission? Those are two different ways of paying. Now your commission is going to be a fixed expense because it's going to be always that amount. If it's salary, it will depend. If they're a W-2 employee in the United States, it's going to depend on how many hours they worked per week, not per month, per week. Okay? So then you multiply that by the 4 weeks. Okay? So if they work more than the reason why it has to be weekly, because labor law mentions that if you work more than 40 hours in a week as a W-2 employee, you have to pay them time and a half for every hour over that. So technically for every minute over that, really technically. So for example, you worked, okay, so the fixed expense for the salary would be the same rate of salary, 40 hours, that's fixed. The variable cost will be different than the fixed cost. Why? Because the variable cost is going to be time and a half. It's not the same as time. So let's say you pay an employee $20 an hour times 40 hours. That's fixed. It's always going to be that way. But some months you have more hours and some months you have less hours. So what you do is you say, okay, I calculate this in two parts. One is the fixed and one is the variable. You add them together as the total cost. One is fixed is rate per hour times hours. And for every minute, well, technically, they say every hour, but you could work a half an hour over that and it's still time and a half. But for every hour over 40, it's time and a half. So it's a 20 times 1.5 equals that would be the new rate. That's the variable cost. That's the new rate for every hour over 40. So suppose they work 20 hours overtime. You're not paying them $20 an hour for those 20 hours. You're paying 20 times 1.5, which is 30. 30 times 20 is 600. So the total cost is 20 times 40 is 800. Right? And then you have, so you have 800. 20 times 4 is 800. That's fixed. Variable is 20 times 1.5 because this is overtime times how many hours? Let's say it's 20. So that's 20 times 1.5 is 30. 30 times 20 is 600. So 800 plus 600 is 1400. Total cost that week was 1400. Now, if it's the same amount so the fixed by definition is the same amount, variable can change. So let's say it was 10, 15, 25, whatever it is. For each week, you added up the total for each one, calculated two ways. The usual times rate is times 40, normal rate times 40, and then you have the overtime rate times how many hours. You calculate it each week, right? You add the first total, subtotal plus the second subtotal, you get the total for that week. That for all 4 weeks, you get a total cost for the month. Now, if you want to know the average, what you do is you take the total after you calculate the total cost, you divide the total cost by 4 weeks, and then you have the average cost. You can have the average overtime cost if you want, which is this is sum of all the 4 weeks. So you add up all 4 weeks and divided by 4. That's average for overtime. And then for the fixed cost, which is normal 40 hours, that would be all the total. So I'll add all those 20 times 40, for example. So that's 20 times 40 is 800 times 4 is 3200 divided by 4 weeks, that's 800. If each week is the same, and you know the average is the same as that week, if it's the same, that's why it's fixed. If variable is where it's going to be different, we need to pay attention to how much it is per hour because it's not the same, it's 1.5 times. So it's the rate, the original rate, $20, for example, $20 per hour, 1.5, that's 30. And you multiply by how many hours, so it depends on how many hours. If it's 20, it's 600. If it's 15, let's say it's 15, sorry. If it's 15, it's 450. If it's 10, it's 300. And if it's 5, it's 150. Right? Add up all those. 600 plus 450 plus 300 plus 150. Add all them up total. Depends on how many hours or the 40. That's where it can be different. Now, payroll tax is something different. As an employer, you'll pay the federal government taxes of an approximately 14% of your employees' wages and salaries. This is, of course, approximate, and it's going to depend on how much money they made. So what was their gross salary? This means how much did they make before taxes? So what is the salary that you pay out? You take it, then depending on how much it is, there's a tax bracket that the IRS has. And you go based upon X, let's say A and B. Let's say between the first amount and the second amount, this range between 1 and 2. Or let's say between A and B, there's a range of numbers. If it falls, whatever numbers it falls under, income, that's the percentage. And the percentage and the tax. Also, Social Security has their percentage. You have a different calculation. And if you want to look at the total amount per year, what you do is you take each month's total payroll tax you pay. So it's basically the total amount of that payroll tax that you paid for those 4 weeks, and then you multiply by 12 months, and that'll give you a yearly expense. So it depends on how you want to calculate. If you want to calculate average, you take the total amount divided by 12. If it's the same amount every month, you just look at what it is for the monthly, because it's the same. So 800 times 4 is 3,200. 3,200 divided by 4 is 800. So if they're the same, that's your fixed, that's going to be the same every month. Therefore, the average is going to be the same as 1 month, because divided by how many months. Now, rent and lease is the next major item to consider. This is usually a fixed expense. So unless you plan to operate out of your home or somewhere other space, you result in additional out-of-pocket. That will not result in additional out-of-pocket expense. If you're not renting a commercial space, however, bear in mind that your local zoning laws may affect you. You want to check out zoning ordinances before you go ahead with your plans. So I have to calculate what is the cost of this. Whatever the cost of this is what it is. You factor that into the cost. So you have your payroll tax, you have your rent lease. Okay, so we look at that amount. Some of this is very straightforward. So if you don't have a rent lease, then you don't. It's zero basically. You can itemize it, but it's zero. If we're talking about advertising and marketing, you have to take the total cost of that. What is the total cost that you spend on advertising, marketing and advertising. Okay, so there's different types of marketing and advertising to consider here. There's different types of advertising that cost money. So that's why it's called marketing and advertising. There's different ways you can do it. I'm not going to really go and read all of that because it's not necessary. Um, so in terms of if we look at expense allocation, in terms of budgeting, and in terms of accounting, what you do is you allow a set of percentage of gross sales for promotion. This is a set aside budget for that particular expense. Okay. And what the author is recommending is 3 to 5% of sales revenue as a budget figure. So it depends on your need. Also, they say they allocate half of that amount for catering and low-level effort to let people know about the product or service, and schedule the other half to advertise in special events. So this is a recommendation, but do as you think is best. You just need to think about what you will need. Think about what you will need. And then it's recommended, for example, half of that for low-level effort, right? And then the other half for product or service to schedule the other half. The main thing is you need to think in advance what will you need. That's what you budget for to do. Think about what you'll need to do, what you need to do to tell people about your business. Will your business need cards? What you do is you say, okay, here it is. You've got all the categories. So what we're doing is we have two major divisions. We have revenues and expenses. We itemize everything that makes us money, revenues, everything that costs us money. All the things that cost us money, we subdivide it into categories. Okay? Well, we have, as we were talking about here, each category you put how much. Now, to logically figure out what we'll need, you have to think about what does the business need to operate to do that. That's what you have to do. For example, cards, flyers, newspapers. Those are our newspaper ads, for example. People don't really use newspapers, so I would say cards, flyers, any online advertising, etc. Even promotional activity. You could also hire a consultant who specializes just in that. So a part-time marketing expert to help you to pull these together. Basically, what you're after is a marketing campaign, and knowing, see, if you're not here, here's the thing. Okay, you want to run a business, you got to look at the big picture first, have everything itemized and calculated out, right? But then to make each part of the business work, you need to make sure that either you yourself are competent in doing that function, or you have the budget to pay somebody to do that. If the answer is no to both, then you can't run a business. You need to have all parts, just like in a car. You need the engine, you need the wheels, you need the carburetor, you need the battery, and so on. You see what I'm saying? You need all parts. You can't be without some parts because it just won't work. You also have advertising. You need to consider some marketing. Basically, is to get attention to your product or service, show the value of the product or service. And you have an advertising. You have a marketing campaign. Then you have the actual advertising, which is the execution of the marketing campaign. What you need to make sure is you spend the right money in the right places. So that's why if you hire a consultant, even on a part-time basis, what you need to do is consider how much work do you need to get done. Now, if you don't know, you can pay somebody or ask somebody to help you with how much work you need to get done. Basically, what you're trying to do is based upon your individual circumstances. What you need. Sometimes what you can do is if you know the if you calculate if you've considered the right industry, you can either there's two ways. Either you can look at the average and the industry has in general, or your individual needs, which is what I would recommend more, is look at your individual needs. There's also other information about what you'll need. You can look at trade associations. So the problem, what you're going to need to avoid is spending too much in the wrong places. So that's why you need to consult with the right people, either a consultant, you can talk with friends, associations that deal with that. And then once you have a budget for special promotions and continuing low-level advertising, write both amounts in the profit and loss forecast. Why? Because we need to account for how much is it costing us. Now, we also need to consider the other expense of insurance. See, this is just an explanation about before we had it itemized from the previous chapter, right? Now we need to explain how and why this works. How does this work and why is it working this way? Why does it work this way? Um, so you're gonna want to have insurance to protect you from litigation. So that's one thing. Also protect you from like disasters like fire, flood, or earthquake. You need that kind of insurance. Any liability. If the public comes into your business, you have public liability, proper damage, public liability, and property damage insurance. So we have those things under the category of insurances. We need to take the total cost of the insurance for all things that we need for insurance and consider that and add that up to find out what we need or what how much it's going to cost. What you want to do is talk to insurance brokers specialized in business insurance. Remember, what the insurance we purchase is based upon our individual needs, not what someone else needs. The idea is to protect you against obvious risks. Now, also, you have to consider the accounting and books. You can do your own books if you like working with numbers. Chances are, however, you'll be busy with the business. You won't have time for that. One good approach is to budget for a CPA or set up books initially to hire a part-time bookkeeper to do day-to-day upkeep. Because you need to keep track of everything that you put into the business. So you're itemizing, keeping track of all the itemized expenses, the revenues, etc. When it's simple, you can do it yourself. When it gets complicated, you need to hire a CPA, which is a certified public accountant. You need to budget for that because, of course, they're not going to be cheap. But those are people who don't work for free, obviously. Okay. Now, if you're going to do it yourself, you're going to need to understand some basic things about accounting, and you're going to need the proper software for the tools. Some examples are QuickBooks or there's other programs. Basically, what you're going to need is you're going to need to have the know-how or hire someone with the know-how, and then you're going to need the tools, which is the software. Now, when the business gets bigger, you're going to need, and there's more work to do, you're going to need to have someone full-time doing that. You have your bookkeeper to keep track of stuff, and you have your accountant who looks at the overall picture and calculates things. Okay, those are two different things, related but not exactly the same. So yes, if your business grows enough, you have extra features of statement and payrolls you want the computer to provide, and so forth. You'll need to research different. So you look at once the computer grows, or once a business grows, you probably want to use a computer program. If it's small, you could just write it down, but I recommend you actually type it into the computer, or put it into the computer. That way, you have a record of it and back it up on a cloud or some sort of backup software backup solution. You can have it locally on a device and or on the cloud, what they call the cloud, which is a website where you back up your information. Now, the other thing is interest. Now, interest is a percentage of the amount, a percentage of principal. Just like when you pay a loan, the interest paid is the percentage of the amount. So, interest, in terms of earning interest, if we're talking about revenue now, not if we're talking about assets, right, that produces revenue, this would be a percentage on the money that you have in your account. So this is under your profit and loss forecast. Concerns interest portion of payments you make on any money you borrow. So that could be liabilities. So this is payments you make on any money you borrow. That is considered the liabilities area, or otherwise known as expenses. So you have your main two categories. So when you draw a paper, basically it's like this, right? You have a piece of paper, you draw a line down the paper. On top of it, you have a line as well. So one major category is you have assets and liabilities. It's called a T account. Top assets, liabilities. Under assets, you have revenue, anything of value. You have expenses, anything that takes away value. That's why you have assets and you have liabilities. That's when you get your net worth is assets minus liabilities equals net worth. Okay, so taking revenue, the total amount of money coming in, that's interest that's an interest earning account, revenue, interest paying account. So in terms of accounting, if you want to get real technical, we talk about accounts payable, which is the liabilities, receivable, which is the earnings. Depending on what type of account, depending on which one it is, under accounts payable, accounts receivable. But in this case, accounts payable is interest on accounts. This is your expenses. So we have revenue and expenses under assets. Under assets, we have revenue. Under liabilities, we have expenses. Then under those, we're gonna itemize and list what they are and how much. What is it, the source, and then how much. And then we can calculate many different ways. How much it costs you per month, how much is this, how much is that, per week, like let's say per month, per year, and then the average. Well, average doesn't matter, but we look at the total. We subtract it every month for the payments. See here, monthly payments going to remain equal. As the portion of payment that is credited to the principal increases every month, while the portion of her payment goes towards interest decreases. Because what they're doing is, as you're paying it down, it decreases. And what they do for most times is they do what's called front loading. And front loading is they put the interest first, then the principal last. So that could be in terms of balloon payment, where after you've paid off all your interest, then the principal becomes immediately payable, as in immediately you have a responsibility to pay that. Let's say you don't know how much money you'll borrow at this time. After all, the main reasons for doing a business plan is decide how much money you'll need to finance. So here's what you need to do. Decide how much money you'll need to finance your business in case that you have how much money you'll need to finance your business, meaning how much capital, how much money will you need to start this business. So you'll have three choices to consider. Number one, you can complete the profit and loss forecast. Okay, that's one thing. In this chapter, and the cash flow forecast in the next chapter. So you have profit and loss. How much is How much you're going to profit, how much are you going to lose. Profit and loss has to do with revenues and expenses. So revenues expenses equals profit. Loss is so the for profit and loss. So profit is you either make more than you spend. Loss is you spend more than you make. So it depends. It's either one or the other. So it's either one or the other, profit or loss. So you compare. And then the reason why you profit and loss is because each month, how much did you was it profit? Month 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Each month, did you get a profit or did you get a loss? Remember that? You have a number, parentheses, that means that's a loss. Add all those up together. This positive means profit. The one in parentheses or minus means loss. Now, if it says 0, that's break even. All up together, what do you get? That's your total profit. And after you add all that up together, you can look at the monthly average. Average profit or loss equals total profit or loss equals. Just like that. You can complete the forecast without showing any loans or loan payments because this is going to be gross, or it's not going to consider everything. Depends on what you need to consider. If you don't have that, you need to include that. You can complete both forecasts without showing any loans at all. You can include discussion about how much money you'll need to borrow and the cash flow available to make repayments. Obviously, you don't take out a loan unless you can repay. There are loan progress charts and computer programs that show exactly how much of any payment is interest and how much is principal. What you need to find out is how is it calculated. That's the disclosure they have to say. Now, here's an example of a loan interest calculation chart. What you do is you look at all the months. You look at all you categories. You put A, B. You put a letter to each category. Month, balance, monthly payment, interest paid, principal paid, and new balance. So, for example, month. So you do it horizontally. All of June. You take the month, the month of that year. So June of whatever year. What's the balance? Okay. So the balance is going to be everything. It's going to be left over after balance. So here it shows B minus E, which is new balance refers to your previous balance. It's either previous or if it's the new balance being on the second entry. So it would be the first entry is the first one, second entry is the second one, obviously. So what you do is you take the first entry and minus everything. The second entry, where it says new balance, that's going to be your new amount. To calculate that, what you do is you take the month, you calculate everything month by month, so you itemize it. Okay, it's June of whatever year. And you take if you don't have a new balance, what you do is you take whatever money you have, take the payment, you minus that, okay, minus the monthly payment. Then you multiply the balance times percentage divided by 12. So if whatever the percentage is, you take the balance, you multiply the percentage because it's a percentage of that amount, and divide by 12 months because that's the interest paid on average per month or every month, which is average. And then you take the principal paid, so you add that as well, you subtract it as well from the original balance. So you subtract all these liabilities, and when you get a new balance. You get otherwise known as the final balance. Then what you do is you carry over the new balance from the previous month from the end of the previous month. You carry it over to the beginning of the next month. You do the same calculation, subtract the monthly payment. You calculate the interest paid, principal paid, and what is the new balance. Okay, take the new balance from the end of that month, carry it over to the first month of the next month, carry it over to the beginning of the next month. Same thing. We have the balance, subtract the monthly payment, calculate the interest paid, so subtract that from the interest paid. Then we have the principal paid, calculate that number, subtract that, and finally you have the new balance for the next month. The end of this month. So the idea at the end is you want to calculate what is the amount at the end. Otherwise, they call it the new balance. See that? Notice how the new balance is carried over to the next month. See, because that's what you have left over. It's just like if you balance a check. You put the amount you put in and subtract the amount you take out. See, how much did you put in? $50,000. How much did you take out? The monthly payment. You took out the interest paid, and you took out the principal paid. Boom. Now you have a total amount left over. That's the new balance. That's the money left over. Now, keep in consideration that you can't write the entire loan payment amount on your profit and loss forecast because the IRS does not consider principal payments fixed expenses that can reduce your taxable income. Also note that a note of sanity. You don't need to be perfect in forecasting your interest costs. Just make the best informed guess. You can check with your banker, CP, realtor, or bookstore for loan repayment tables. So those they can give you that information. Remember something, this is a forecasting. This is you're trying to figure out what it's going to be based upon the previous information. Obviously, you can't forecast if you don't have information. See what I'm saying? Make sure the sum of your interest payments here and the principal are make sure of the sum of the interest payments. So you add up all your sum is adding everything up or an addition of everything. You want to add up all your interest payments. We're going to talk more about that in the next chapter about interest payments. Now we have another consideration in accounting called depreciation. Now depreciation is which is basically is an amount that you subtract from your profits when you pay taxes. So this reduces what's called tax liability. Like I said, everything I'm saying is in context. This is subtracting from your tax liability because it reduces your profits. I mean, this equipment you have is an asset that's worth a certain amount. But when it's depreciated, it's worth less. So because your assets are less, because ultimately it's assets minus liabilities equals 0. You know what I'm saying? It compensates you for the fact that your business equipment and buildings are wearing out, meaning it's depreciating in value. Okay? The government allows you to assume your fixed assets wear out over time of years, meaning that for tax purposes, your assets are worth less at the end of that period. Your depreciation allowance simply lets to show the percentage of the wear as an expense on your tax return each year. So basically, each year you can take a certain amount of depreciation assets of depreciating assets. Assets to depreciate. There's a certain amount each year you can take as an expense or as a depreciation expense to be more precise. That reduces from your profit. You can take as a minus from your profit because you're taxed on the profit. Now, here's some examples. Office equipment. Office equipment is depreciated over 3 to 5 years, and buildings over 15 to 30 years for tax purposes. How much you can depreciate in the first year may not be the same as the second and the third. And the second may not be the same as the third, and the first may not be the same as the second. Do you understand? But The idea is you each of those 3 to 5 years you can depreciate a certain amount. Buildings also, if you own a building, you can also depreciate that over X amount of years as well. That's what it is. IRS publishes very explicit rules and lists of what can be depreciated and how fast. How fast is based upon a percentage of the original value of the asset. So basically, you can depreciate all fixed assets that last longer than 1 year. Remember, you don't show the purchase price of the expense on the profit or loss statement. Show the purchase price. Okay, because it does include probably tax. So you have your item cost and then times the total sales cost has to do with the item cost, and then plus the product plus so item cost plus the tax, any other expense. So the point is we need to find out what is that actual item worth, not how much did you pay for it. Maybe you paid less than what it's worth, or maybe you paid more than what it's worth. That's what it is. If the asset will last less than 1 year, you simply show the entire purchase price, the expense column for the year. So it depends. Is it 1 year? Sorry. If the asset will last less than 1 year, you can show the entire purchase price for the expense column for the year. If you bought the equipment and do not depreciate it, the year, excuse me, okay, sorry. If the asset will last 1 year, simply show that the entire purchase price for the expense of 1 year. Yeah, okay. You bought for 1 year that you bought the equipment and do not depreciate it. Inventory of goods. So basically, if you don't depreciate it, you can show the full cost. If you do depreciate, that's a different number. Inventory of goods available for each consumable supplies are examples of purchases that are expensed immediately because they're less than 1 year. So this has to do with and this is in relation to depreciation, not in relation to not relation to actual expenses. This has to do with depreciation, what you can depreciate based upon. So it's what you can depreciate of fixed assets what you can depreciate of the assets that you've purchased. Sorry. Now we also have other expenses. Inevitably, you'll encounter a number of other expenses for your business. Spend time thinking about these using the company list of starting point. Okay. Then list the other expenses you expect to incur. Also, if you expect any of these to be reoccurring expenses, include your monthly estimate for each. Remember, this is a forecast, not a tax statement. We're forecasting to get an idea about the total expenses compared to our total revenues. We also have to consider, of course, the total fixed expenses, as we talked about before. We also have the profit and loss statement, which we just talked about. That's from gross profit. What you do is you subtract the total fixed expenses, then fill in all the results. So you take the gross profit minus total fixed expenses and give you profit and loss, like we just showed you before. And finally, you have your total after you've added all this together. All this, your total. What you do is with your total is you add up all of your rows, lines 1 through 6, for example, or whatever the row numbers are, and enter the yearly totals under your total column. That is, you add everything up and add your total. Very simple, right? Simple math, simple logic, right? Check your arithmetic by seeing if the monthly prior figures add up to the 7 figures of your yearly total. One of the things that accountants do is they use calculators to double check that the your arithmetic is correct. Make sure all the addition and subtraction, multiplication and division is all correct. Okay, what I recommend you do is just to double check this. Calculator. It'll be a little faster, and you can be assured that it's correct. What I would do is I would do this to double check. Don't rely on the calculator, but use it as a double check. Now here are some common expenses also to consider. You have these are all your common expenses you need to consider as well. You can see that as well. Some of this we already mentioned, sorry. Now, the last thing we need to do is we need to review our profit and loss forecast. We have all this accounted for. We say, okay, this is our forecast. What we need to do is say, okay, here we go. You've now completed your first run through a profit and loss forecast. Date it as you date it so you won't be confused if you do another draft. Excuse me. You need to know when was this done and compare it to a new. That's like let's say that's your rough draft. That's your first draft. Okay, your second draft to make sure are you getting different numbers or are you getting the same number? Okay. If you're finding that your profitability is too low, so if you need to increase profitability and make the business a good economic idea, go back through all your assumptions. How can you reduce costs or increase volume? When they say volume, that means quantity of sales and quantity of revenue. See, it's basically if you want to make more profit, there's two ways. One and or the other, which is one is you increase your revenue, which is increase sales, and or, which is you can do one or the other, or you can do both, which is and or. Either you increase your revenue, or you decrease your expenses, or you can do both. If you do both, actually your profit. But generally, it's either increasing revenue or decrease expenses. Now, I'll just give you a general. This is the general idea. Now, one way to approach the issue of profitability is to look at your profit forecast from an investor's point of view, or whoever's point of view that you're going to be dealing with. Banker's point of view, investor's point of view, or whoever's point of view. For example, a $35,400 profit from the dress shop or from whatever shop won't seem much to them. They'll be concerned that the shop owner will have a difficult time earning a living and making it through the inevitable slow times. An investor or lender will probably want her to be able to convincingly demonstrate that it's a plan to increase sales enough to raise the profit forecast. That's why I told you need to calculate how much per sales. We need to calculate how much is it costing per sales, and what's our gross profit. What we need to do is first of all increase our gross profit, and then at the end increase our profit overall compared to, and reduce any losses, any sales or anything that we do. Overall, the net effect should be that we should be increasing profits and finding ways to increase profits. Remember, how do we increase profits? We increase sales, we increase the revenue, which is the increase the amount of money coming in, and we reduce expenses, the amount of money going out. Now, the profit and loss forecast in terms of income tax return. This is our last section before we finish. Figuring out your business's income tax return invoices more calculations than we have shown so far. One major difference involves the cost of sales, which we viewed as a simple percentage of the sales for forecasting purposes. Yes, you'll need to follow more complicated rules when computing your business income. So there's more complicated rules when computing your business income tax return. So there's more considerations. Not just what you think it is, but what is the actual result? What did you get at the end? And what are all the factors? Not just the pros, but all the factors included. Maybe there's other factors. Maybe there's other things too. You check all the considerations that are relevant to what we're doing and the type of business we're doing. Now, another thing we need to do is we need to calculate a total dollar value of goods that you have on hand. These are for assets, okay? And oh, sorry. Before you do that, you need to have historical data so we can make a comparison year to year. Okay, first we need to have 12 months of it, months to reconcile the real inventory, which we put in the computer. Okay, so a computerized inventory system tell you how much inventory you have at a time. This is if we're dealing with inventory or physical inventory. Again, we need to consider what type of business are we in. Even if we're in a service-based business, we still need good records on how much did things cost per sale, how much are you getting, and how much are you spending. That's you still need to consider. But if we have physical inventory, that's even more because we have to consider what our inventory is, how many of each unit of whatever, how many do we have of whatever item. Okay? And then what it is, you complete the listing description, count all the goods in your store at a particular day. Like I said, how many of those do you have on hand? Then you apply the best figures you have for the merchandise when you bought. You multiplying the unit cost of each item in your sales by the number of items you have and adding purchases during the periodic, in the period gives you the cost of the goods available for sale. So this is how much did it cost you to sell them. For example, say you have 100 items for sale, right? But it costed you money to get those 100 items, right? Okay. So what we do is we take the cost per unit, each item, and we multiply by 100 of if let's for items that are the same cost items, we multiply by how many, and then we itemize it accordingly. Item one, it's we have let's say type item one type. It's we have 100 of this, and then we multiply how many is of each is the cost to purchase, and we have a total. The same thing. We itemize all of them out, multiply by how many, we get our subtotal, we add up all our subtotals, and we have an actual running total. All running total. That's the total that we're working with. Otherwise known as the running total. Okay? Now, once you develop the total value of the goods on hand, which is what it is, the total value, once you add up all that, then what you need to do is you calculate the real cost of sales. What you do is you add together all the goods that you purchased during the period of the inventory amount, which you just did, at the beginning of the period, so we know month to month how much it is. So month one we purchased this amount, this month 2, 3, 4. Add all that up. And number two, from that amount, subtract the dollar value of the inventory at the end of the period. So if let's say the dollar value subtracted, we subtract that. In addition, for instance, the cost of sales for that period. Subtract the dollar value of the inventory at the end of the period. So let's say the dollar value is how much it costed for it. What was it? How much did it cost for you to obtain that items? And when you sell more of those items, you subtract from that dollar cost amount, and you have a new running total. I'll give you an example here: cost of sales. What we do is we say, okay, at the beginning of any inventory of physical amount, we say it's worth $10,000, for example. you do is you add purchases during the period. So we added another 30,000. What do we have? We have 40,000. 10 plus 30 is 40, obviously, right? Then we subtract some of the inventory that we got rid of, either sold or whatever, shorted. Then we subtract 15 from the inventory that we no longer have. And what do we have? Cost of goods sold. Means what is the cost going to be to sell the goods left over? Now this is important from a break-even standpoint, because we need to know what is the actual cost, not the profit, not the revenue, not the gross profit, not the revenue, but what is the actual cost of goods? That's how much each one costs times how much in the inventory times the unit price equals that amount. We itemize it for each one that we have. And so we add it, we calculate for each one. So we have the price of the item times how many items equals your subtotal. Itemize all of them, add up all your subtotals, you have your running total. Then anything you've gotten rid of in the month, you subtract that amount. Suppose we had, let's say, 1,000 items. Let's say they all costed $1 each. I don't know, whatever. $1 each, whatever. Let's say $2, whatever. We have uh, we have 1,000 items of, let's say, computers. We have 1,000 computers. Computers, 1,000 of them times, let's say 100 of them times 1,000, right? 1,000. Let's suppose we got rid of 50 of them. 50 out of the 100, right? What do we have? 100,000 minus 50 times 1,000. That's 50,000. What do we have left over? 50,000. We take our original inventory, the cost of the original inventory, minus what we've gotten rid of. What do we have left over? That's the cost of the goods sold. Because we subtract the ending inventory. Because here what we want to do, we want to find the goods available for sale. Then we want to reduce the ending inventory from physical count, that's less, not the. So we take the original amount less, and then we have the difference in the end. Let's say we have 40,000 worth, we got rid of 15,000 worth, now we got 25,000. That's simple. Okay, now we need to use this calculation this calculation has used more than just filling out forms for the IRS. It can let you know when somebody is stealing from you because we need to check our inventory. If you know, for example, you have 100 items, and let's say you only sold 10 of them, you should have 90 left over, right? But let's say you do an accurate inventory count and you only have 50 left over. Where's the other 30? Well, that's your shortage. You're short 30, see? That's your shortage. I believe they also call it pilferage. That's your shortage, 30. You're short 30. See what I'm saying? Because it's the items that you no longer have on hand, but were not sold. You take your total amount you have on hand minus your sales. You should have that amount, the difference. But if you don't have the amount, whatever the difference is from what you should have, which is in the beginning inventory, right, and what is sold, ending inventory should be those two numbers. If it's not, whatever the difference is, let's say you have 90 and you sold 10, you should have 80. Let's say you have 90 items, you sold 10 items, you have 80 items left. You should. But if you actually only have 50 items, that means that 30 are lost somehow. Maybe they were stolen, maybe there's a miscalculation. You have to find out the reason why. That's also a loss of the business. Now, Suppose you have a good estimate of what the cost for sales percentage should be, either from the past statements or from a good understanding of your business. Suppose further you expect cost of sales to be 61.5%, that you actually had a cost of 77.3%. See what's the difference is that is the loss. That's the shortage, otherwise known as a short or a shortage. That's the difference. Shortage is the difference between actual and what you should have and your actual. What does that mean? It means means that some of the merchandise you buy for resale is leaving the store without entering into your register. This is a management problem. This is a financial problem. This is something you need to look at. At any rate, it means you need to do some serious research to find out what has really happened, because you're losing money. Every item that doesn't get sold that's not on hand, you're losing money. Okay, all right. So that should do it for this chapter. What I'd like you to do, if you need to, replay some of these things. Okay, get the idea down, because what we're trying to do is we're trying to calculate. Okay, when we go back to our objectives for the chapter, we're trying to forecast a profit and loss. Remember that we need to put our revenue in first for each month. The revenue for each month and compare it to our cost of the sales in terms of a percentage. So we take our revenue, we multiply it by the cost of sales, and we get that amount. That means that's the flat amount of sales, and you get your gross profit. Your objective is to get the gross profit. Okay? Once you have the gross profit, you can subtract that from your fixed expenses. Once you have that, you have sorry, you want to take your sales revenue, you want to subtract the cost of the sales. So you can either you can calculate it as a percentage first. So you take the revenue times the percentage of the revenue, give you the amount, so you subtract the revenue from the cost of the sales, you get your gross profit. Once you get that number, remember that you need to add up all your fixed expenses. And then you take your gross profit and subtract your fixed expenses, and either give you a profit or loss. Remember that. Okay? That's part of your profit and loss forecast. Okay? This is quite easy, but it is what it is. Remember, you need to itemize everything here for your sales to do that. Remember, do it one sale at a time. Okay? And you need to do it for every month. You need to do everything month by month, going down, not sideways, going down, so you can add everything. Remember, you need to have an accurate accounting of how much that costs. Remember, I recommended you use a calculator to double check, not to do the work for you, double check the numbers. What you need to do is you have the profit and loss forecast on your business plan to see how well the business would do based upon the projected or the forecasted fixed expenses and variable expenses. So we have the revenue minus the cost of the sales for gross profit, subtract the fixed expenses, get that amount. Okay, that's what we're going to do. Make sure we have that all itemized and listed with the numbers month to month, what that would be. And we can consider that. We need to do this before we open a business, not after. And remember something from the profit and loss forecast. We need to understand what it is, what's the purpose, and what is it. We need to understand our average cost of sales. That's divided by how many months, years, whatever. Remember, we need to complete the profit and loss forecast. That's our itemization with the numbers, and we take the difference. And we need to review it to make sure it's correct. And then finally, we need to make sure that we've got all of our information in terms of taxes Remember that we have other things that's, that takes away from the profit, such as depreciation of assets. Now, I know that was quite a bit for a chapter, slightly complex, but if you do it step by step, like I was showing you, the key thing is just to write things down very simply. That's all of your revenues, take total revenues from each transaction, or in other words, each sale. You can say how much it costed or the percentage of it. If you know the profit margin on each sale, then what you do is you take the revenue, subtract the profit margin, and you'll get your total costs. If you know the total cost, what you do is you take the total cost divided by your revenue, like we showed you last chapter, and you get the percentage. And then if you want to double check, what you do is you start with 100%, which is obvious. And you get that percentage. You get the left, then you get to the difference, which is whatever the percentage is. What you do is you take that, you get that percentage, you multiply by that revenue, and it's the amount of gross profit. That should equal your gross profit in total for that month. Make sure we add up this all 12 months from beginning to end. Itemize it going down for the gross profit and fixed expenses, the difference, and then the total. Okay? All right, so what I recommend you do is implement this as part of your business plan before you start a business. That way you'll be successful in whatever business you're going to start. So what I'd like you to do at this point, I'd like you to click like, which is the thumbs up on the video, as I will have this uploaded to my YouTube and Rumble. Please, if you haven't already, please click subscribe. That way you'll have access to all my content on this channel. And also, if you haven't already, please click the bell button. That way you'll be notified of all my future videos. I would like to thank you very much for watching this video, as I do appreciate that. I know this added value to your life, especially if you want to run a business and you're just new to it. I'd like to wish you a great day wherever you are in the world. Take care, and we'll talk to you tomorrow.